Have you ever seen a stock skyrocket and thought, why didn't I spot that earlier? It's a frustrating feeling. But the truth is, it's not magic or luck. There's a repeatable way to identify high potential companies before they make headlines. In this video, I'll show you how I approach this step by step. No hype, just a clear strategy based on logic, research, and long-term thinking. Let's begin with a simple question. Why not just stick to index funds? Index funds are great for consistency, diversification, and long-term growth. They track the overall market, which historically delivers around 7 to 10% annually. That performance is largely driven by the steady expansion of global liquidity and economic growth. But here's the catch. Index funds reflect the average. That means you'll never outperform the market. By definition, you are the market. If you want the chance to achieve higher returns, especially by spotting undervalued or fast-growing companies early, you need to look beyond the index. That's where individual stocks come in. When you invest in individual stocks, you can potentially outperform the index by spotting opportunities early. You can focus on specific sectors you believe in. In my case, that's tech. It's a field I understand and actively follow. From AI and semiconductors to digital platforms and cloud services, innovation is constant. And with every innovation comes the chance to invest before the crowd notices. Part 2. How I enter a sector. It starts with interest. If a technology or trend grabs my attention, I begin exploring the companies behind it. I look for names that aren't always on the front page. For example, let's say I notice a growing demand for enterprise automation or cloud infrastructure. Two trends shaping modern IT. Instead of only looking at giants like Microsoft or Amazon, I might come across companies like ServiceNow, which specializes in workflow automation, or Arista Networks, known for high-performance cloud networking. When exploring a sector, always ask yourself, what real-world problem does this company solve? And is that solution becoming more essential over time? Once I've found something promising, I do a quick surface check. Revenue growth, recent news, maybe Glassdoor reviews. If I'm still interested, that's when I dive deeper. Part 3. My step-by-step stock analysis. Here's the system I use to analyze companies, clearly and consistently. 1. Management and leadership. Good companies begin with good leadership. First, I check Glassdoor to understand how employees rate the company. High ratings often mean a strong work culture, which leads to better performance over time. Then, I look at the CEO. If the CEO owns a large stake in the company, it shows alignment with shareholders. A CEO with real skin in the game is more likely to think long-term and focus on sustainable growth rather than short-term wins. 2. Financial metrics and asset situation. Next, I use platforms like AlphaSpread and Stock Unlock to analyze the balance sheet. How much debt does the company carry? What is its liquidity position? Is the company undervalued compared to its intrinsic value? I pay close attention to key balance sheet metrics like the equity ratio, current ratio, and debt to assets ratio, because they show how resilient a company really is. The equity ratio tells me how much of the company is financed by its own capital rather than debt. A higher number here usually means more financial stability. The current ratio compares short-term assets to short-term liabilities. If it's above 1, that means the company should be able to cover its bills in the near term. And the debt to assets ratio shows how much of the company's assets are funded through debt. A high number could be risky in a downturn. By combining these metrics, I get a clear picture of how well a company could handle stress, and whether it has the flexibility to invest in long-term growth. 3. Income statement. Strong businesses grow steadily, not just occasionally. That's why I look for consistent revenue and net income growth over multiple years. It's not enough for a company to have one standout quarter. I want to see a reliable upward trend that shows the business is scaling sustainably. To get a better picture of the company's profitability, I also look at operating income and EBITDA. Operating income shows how much profit the company generates from its core business activities before interest and taxes. EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, helps me compare profitability across different companies without accounting differences distorting the view. But numbers alone aren't enough. I always compare these results to competitors in the same industry. This tells me whether the company is truly outperforming, gaining market share or operating more efficiently, or whether it's just riding a general trend that lifts the entire sector. 4. Cash flow. Positive free cash flow is absolutely essential. It shows that the company generates more cash than it needs to run its core operations. This excess cash can be used to reduce debt, reinvest in the business, pay dividends, or buy back shares, all signs of financial strength. One major red flag is when a company pays dividends but doesn't generate enough free cash flow to cover them. That usually means they're either taking on debt or selling assets just to maintain the payout, which isn't sustainable. Another factor I watch closely is stock-based compensation. When management receives large amounts of shares as part of their pay, it increases the number of shares outstanding and dilutes the ownership of existing shareholders. If stock-based compensation consistently exceeds the company's cash flow, that's a warning sign of poor capital discipline. Analyzing cash flow gives me a realistic picture of the company's financial flexibility, whether it can grow and reward shareholders without sacrificing long-term stability. 5. Competitive advantage, also known as a moat. Finally, I evaluate whether the company has a sustainable competitive advantage, often referred to as a moat. A moat is what protects a business from being overtaken by competitors and helps it maintain strong margins and consistent profits over time. There are several types of moats I look for. Brand power. Companies like Apple or Nike have incredibly loyal customers. Their brands aren't just recognized, they are trusted. That gives them pricing power and keeps users in their ecosystem. Unique products or intellectual property. Think of companies like ASML, which holds a near monopoly on EUV chip-making machines. Patents and proprietary technologies create a barrier that competitors can't easily cross. High switching costs. Businesses like Adobe or Salesforce benefit because their customers rely heavily on their software. Switching to a competitor would be costly, time-consuming, or risky, so users stay. Network effects. Platforms like Google, Meta, or Amazon become more valuable as more people use them. More users mean more data, better services, and a wider gap between them and competitors. Cost advantages or scale. Some companies dominate because of their ability to operate more efficiently. Walmart, for example, uses its massive scale to keep costs low and undercut smaller retailers. A moat doesn't guarantee success, but without one, even great financials can fade quickly. With a moat, strong companies can protect their profits and compound value for many years. And that's exactly what I'm looking for as a long-term investor. Part 4. Putting it all together. Once I've worked through these 5 steps, I ask myself one key question. Is this a company I'd feel confident holding for the next 5 to 10 years? If the answer is yes, I consider starting a long-term position. From that point on, it's all about staying informed, not overwhelmed. I keep an eye on quarterly reports, listen to earnings calls, and watch how the company executes its strategy. But I also remind myself not to overreact to every headline. The news cycle is full of noise designed to create panic, even when nothing fundamentally has changed. With time, you learn to distinguish between irrelevant short-term noise and truly meaningful updates. And that's one of the most important skills in long-term investing. Staying focused while the world around you tries to distract you. So how do you tell the difference? It starts with asking yourself one simple question. Does this news change the long-term outlook of the company? If not, it's likely noise. For example, a downgrade by an analyst, a missed earnings estimate by a few cents, or a temporary dip caused by market sentiment rarely changes the core value of a solid business. These are short-term fluctuations that the market often forgets in weeks, or even days. In contrast, meaningful updates are events like a major change in the company's leadership, a shift in the long-term business model, a serious decline in revenue, profitability, or cash flow. Regulatory changes that affect the company's core operations. A disruption by a new, more efficient competitor. Those are signals worth paying attention to. But headlines designed to provoke emotion, fear, hype, or urgency are usually just distractions. The market is filled with noise every single day, and reacting to all of it can lead to impulsive decisions and missed opportunities. Conclusion: you don't need 100 stocks, you need a few good ones. Finding great stocks isn't about catching the next meme wave. It's about understanding real businesses and backing the ones that are positioned to grow. Start by focusing on a sector you know. Learn the basics of financial statements. Look for great leadership and long-term advantages. This strategy won't guarantee overnight riches, but over time, it can help you find the kind of stocks that quietly turn into giants. And the best part? Anyone can learn this system. You don't need to be a professional analyst, you just need a method, discipline, and a long-term mindset.